What happens when two signals from the same market hit their lowest point at the same time, but tell completely different stories? That's exactly the situation unfolding right now in silver, and most people are only seeing half of it. On one side, you have the price. It dropped hard, falling over 4% in a single session, touching its lowest intraday level in months. Anyone watching a chart sees that move and assumes weakness. It feels obvious. Price down equals demand down, right? But that assumption only works if price is the full picture, and it isn't. At the very same moment that price is falling, the physical inventory sitting inside the vault system has also reached a 12-month low. Not flat, not stable, draining. Over a third of total inventory has disappeared over the past year. That's not a minor fluctuation. That's a structural shift. So now you have two data points moving in opposite directions. The paper price says one thing. The physical reality says another. And understanding that divergence is where things get interesting. Most people interpret markets through price alone. It's fast, visible, and constantly updated. But price is often just the surface layer, a reflection of what the most urgent participants need to do right now. In today's case, that urgency is driven by something much bigger than silver itself. Across markets, there's a pattern emerging. Stocks are falling, bonds are under pressure, and metals are dropping at the same time. That kind of synchronized movement doesn't usually come from changing opinions about each individual asset. It comes from stress inside the system. When leveraged positions start to break, everything gets sold. Not because investors suddenly dislike those assets, but because they need cash immediately. And when that happens, they don't carefully pick what to sell. They sell what they can sell quickly. Silver, especially in its paper form through ETFs and futures, is highly liquid. That makes it one of the first things to go when margin calls hit. The result? Price drops sharply, even if nothing about the underlying demand has changed. This is the key distinction. The paper market runs on urgency, while the physical market runs on necessity. Industrial buyers don't care about a one-day price move. Their contracts were signed months ago. Their production lines don't pause because silver dipped 4%. They continue consuming metal at the same pace, regardless of what traders are doing on screens. That's why the vault is draining, even as the price falls. These are two systems operating on different timelines. One reacts instantly to financial pressure. The other reflects long-term consumption. And when those two systems diverge, it creates tension. Not theoretical tension, mechanical tension. Right now, that tension is measurable. The total inventory has dropped significantly over the past year, but the portion of that inventory that's actually available for delivery is much smaller. That's the registered supply, the metal that can be used to fulfill futures contracts. Against that limited supply sits a massive amount of paper claims. The ratio between them has stretched to levels that depend heavily on one assumption, that most contract holders will never ask for delivery. That assumption has always held in normal conditions. Traders roll their contracts, settle in cash, or exit before delivery becomes relevant. But the system only works as long as that behavior continues. If even a relatively small percentage of participants decide they want physical metal instead of cash settlement, the math changes very quickly. It doesn't require a majority. It doesn't even require a large minority, just enough to push demand beyond what the vault can supply. This isn't just theory, it has historical precedent. There have been moments when pressure on physical delivery forced exchanges to step in and change the rules midstream. Not because of conspiracy, but because the system couldn't function under the strain. That possibility isn't something most market participants think about during calm periods. But stress reveals structure, and right now the structure is being tested. At the same time, something else is happening beneath the surface. The financial system itself is dealing with a mismatch that's been building for years. For a long time, borrowing was cheap, extremely cheap. That allowed investors to build large positions using leverage, assuming that funding costs would remain low. But when interest rates rise, that entire structure starts to compress. What once produced comfortable returns becomes difficult to sustain, and when those positions need to be refinanced at higher rates, the pressure intensifies. This isn't isolated to one sector. It runs across private equity, private credit, and large portions of the financial system that expanded during the era of low rates. Now, those same structures are facing a different environment. When refinancing cycles hit, some of those structures won't hold. And when they don't, the response won't be gradual. It will force action. That's where central banks come in. They're caught in a difficult position. If they do nothing, financial stress continues to build. If they intervene, they risk accelerating inflation and weakening the currency. Historically, when faced with that choice, the system tends to favor rescue. Not because it's ideal, but because the alternative is immediate instability. And when that rescue comes, it usually involves expanding the money supply. That's the moment when the narrative shifts. During the initial phase of stress, everything sells off, including precious metals. But once liquidity returns and monetary expansion begins, assets that protect against currency debasement start to move in the opposite direction. We've seen this pattern before. The early phase looks like weakness. The later phase looks like repricing. What makes the current situation different is the starting point. The physical silver market is already tight. Inventory is already declining. The leverage in the system is already elevated. So when the next phase begins, it won't be starting from a position of abundance. It will be starting from constraint. That matters, because price doesn't just respond to demand, it responds to availability. And when availability is limited, small changes in behavior can produce large moves. Meanwhile, most of the mainstream analysis is still focused on the visible layer. Price charts, short-term momentum, daily moves. Those tools aren't useless, but they're incomplete. They don't capture the structural dynamics underneath. They don't measure physical drawdowns. They don't account for delivery mechanics. And they don't reflect long-term supply constraints. That's why narratives form so quickly during sell-offs. Price drops and explanations follow. Overbought, speculative excess, smart money exiting. It all sounds reasonable until you look at the data that isn't on the chart. Because while price is falling, physical metal is leaving the system, not entering, not stabilizing, leaving. That's not what you'd expect if demand were weakening. It's what you'd expect if demand were steady or increasing, while supply becomes harder to access. At the same time, broader financial indicators are showing signs of stress that haven't yet reached headlines. Certain sectors are weakening quietly. Large institutions are showing cracks in long-term trends. But it's happening below the surface, without the kind of news that forces attention. That's often how these phases develop. The signals appear first, the recognition comes later, and when recognition does come, it tends to arrive quickly. Not gradually, not politely, suddenly. That's why timing becomes so difficult. By the time the narrative shifts, the price has already moved. Right now, the market is still in the phase where the paper signal dominates perception. The price drop is visible, immediate, and easy to understand. The physical drain is slower, quieter, and harder to interpret. But both are happening at the same time, and they are not saying the same thing. One reflects forced selling driven by financial pressure. The other reflects ongoing demand that hasn't paused. One is temporary, the other is structural. Eventually, those two forces have to reconcile. The system can't maintain divergence indefinitely. There's a resolution point built into the mechanics. That resolution doesn't come from opinion. It comes from constraints. If the physical supply continues to decline while paper claims remain elevated, the system will have to adjust. Whether that adjustment happens through price, policy, or rule changes is uncertain, but the pressure itself is measurable. At the same time, the broader monetary environment is evolving. Currency dynamics, global trade shifts, and changes in how transactions are settled all feed into the long-term outlook. Confidence plays a role here, not just in supply and demand, but in the systems that support them. When confidence erodes, it doesn't always happen in a straight line, but once it crosses a threshold, the effects can be significant. That's why some analysts talk about a clock. Not a precise countdown, but a window during which these pressures build toward resolution. It's not about predicting an exact date. It's about recognizing that the current structure isn't static. It's moving, and it's moving toward a point where adjustments become unavoidable. In that context, today's price action looks different. It's not just a decline, it's a snapshot of one side of the system reacting to immediate pressure, while the other side continues along a longer trajectory. If you only look at the chart, you see weakness. If you look at the vault data, you see depletion. If you put both together, you see divergence. And divergence isn't just noise, it's information. The question is how long it persists and how it resolves. Because eventually, price has to reflect reality. Not just the reality of leveraged positions unwinding, but the reality of physical availability. And when that shift happens, it won't look like today. Today looks like selling. The next phase, if history is any guide, looks very different. That's why moments like this matter. Not because they provide certainty, but because they reveal structure. They show you what's happening beneath the surface while most attention is focused elsewhere. And in markets, the things that aren't obvious at first are often the ones that matter most later. So when two signals hit their lowest point at the same time, don't assume they're confirming each other. Sometimes they're telling you that something deeper is unfolding, the price is reacting, the vault is revealing, and somewhere between those two, the real story is taking shape.